afternoon, K number 83 of the Monetary Policy Committee meeting of Monday and Tuesday, May 21 and 22, 2012. The Monetary Policy Committee met on May 21st and 22nd, 2012, with all members in attendance. The committee reviewed the conditions and challenges that confronted the domestic economy during the first 5 months of 2012 against the backdrop of international economic and financial developments to reassess the monetary policy options in the near to medium term. The international economic situation. The committee noted that the global economy continued to experience sluggish recovery as the downside risks remained elevated owing to the lingering Eurozone debt crisis, weak balance sheet positions of Eurozone financial institutions, rising unemployment in most advanced economies, geopolitical uncertainties affecting global oil prices, and the legacy effects of the global financial crisis. Growth in advanced economies is estimated to decelerate from 1.6% in 2011 to 1.4% in 2012. U.S. output slowed from an annual rate of 3% in Q4 2011 to 2.2% in Q1 of 2012. The slow U.S. recovery was attributed to the fall in business spending from 5.2% in Q4 of 2011 to 2.1% in Q1 of 2012. In the euro area, real GDP growth is projected to contract from 1.4% in 2011 to minus 0.3% in 2012, owing to the lingering effects of the sovereign debt crisis and the attendant fragility in the financial system. Although the effects of the high commodity prices and supply disruptions from the Japanese earthquake had diminished, the effect of the Greek bailout and the failure of fiscal retrenchment have been magnified by the political impasse associated with the discussions on Greek debt exit strategy. A domino effect on other debt-ridden Eurozone members and possible bank runs could not be ruled out entirely in the euro area if political support is not provided for the already agreed fiscal compact. European governments are confronted with uncertainties that are colored by both political and economic realities. The UK, Denmark, and Dutch Republic, with own national currencies outside the 17-nation Eurozone, have been declared to be officially in recession. There are no immediate plans in the UK for abandoning austerity, and it is not yet clear if the tight fiscal stance is compatible with growth aspirations. In the leading emerging economies, there are indications of a significant slowdown in economic activity. China has revised its growth targets for 2012 downwards from 8% to 7.5%, compared with 9.2% in 2011. Growth in Indonesia was projected to decelerate to 6.10% from 6.50% in 2011, while growth in Malaysia will remain unchanged at 4.4%. India's GDP growth in 2012 is not likely to be significantly different from the 6.5% of 2011. On balance, growth in the BRICS countries is projected to decelerate as asset and currency markets reflect price fluctuations, while banks and other financial institutions are under increased stress. Reflecting the slowdown in economic activities, crude oil prices in the international market has shown signs of declining as supply in 2012 is forecast to exceed demand. In sub-Saharan Africa, inflation is trending upwards while growth prospects are optimistically measured on the back of the resilience of the domestic economy in recent times. However, the new risks posed by the recession in the euro area and Chinese slowdown, in addition to the lagged impact of the legacy factors associated with the financial crisis, could somewhat dampen the growth prospects. In addition, military interventions in some West African countries and continuing pockets of political instability remain a source of concern. The committee noted the general slowdown in the global economy and the attendant softening in commodity prices with present uncertainties to the fiscal outlook, trade, and financing flows to the domestic economy, noting the very dark clouds over global economic recovery in 2012. The growing trade imbalances and threats to financial flows could weaken the external and fiscal positions. Domestic economic and financial developments. Indications are that the robust upward growth recorded in 2010 and 2011 may not be replicated in 2012. Provisional data from the National Bureau of Statistics indicate that real gross domestic product in Q1 grew by 6.17%, down from 7.68% in the fourth quarter of 2011 and 7.13% in the corresponding period of 2011. Overall real GDP growth for fiscal 2012 is projected at 6.5%, down from 7.45% in 2011. This confirms a disturbing and uninterrupted trend of decline going back to Q1 2010. Crude oil production was estimated to have declined by 2.32% in Q1 2012, compared with the decline of 2.41% in the corresponding period of 2011. Non-oil real GDP growth, estimated at 7.93% in Q1 of 2012, was much lower than the 8.73% recorded in Q1 of 2011. Growth in agriculture in Q1 decelerated to 4.15%, compared with 5.54% in Q1 of 2011 and 5.74% in Q4 of 2011. In general, the paradox of rising poverty incidence in the face of impressive economic growth further reinforces the committee's call for the implementation of appropriate structural reforms in the key sectors, notably agriculture, power, and the petroleum sectors, to stimulate productivity. Prices. As anticipated by the committee in earlier meetings, inflationary threats re-emerged in Q1 2012, having moderated in Q4 2011. The year-on-year headline inflation, which was 12.6% in January 2012, moderated to 11.9% in February, but rose to 12.1% and 12.9% in March and April, respectively. Similarly, food inflation, which was 13.1% in January 2012, fell to 9.7% in February, but increased to 11.8% in March, before declining slightly to 11.2% in April 2012. Core inflation, which declined to 11.9% in February from 12.7% in January, rose sharply to 15% in March, before moderating to 14.7% in April. On a month-on-month basis, inflationary pressure was rather benign between March and April, and the rise in year-on-year figures largely reflects the base effects in January from fuel subsidy removal. Overall, inflation indices remain within our forecast range. The proposed upward review of electricity and import tariffs on wheat and the proposed upward review of electricity tariffs and duties on wheat and rice, as well as the rising global food and energy prices, could put upward pressure on prices in the near term. Notwithstanding this, the lingering impact of the aggressive monetary policy tightening measures undertaken since 2011 and the general slow growth in monetary aggregates, as well as the impact of rising fuel prices on consumer spending, may moderate the pressure on domestic prices in the near term. Staff projections indicate that headline inflation is likely to peak at around 14.5% in the third quarter of this year, before moderating steadily towards the end of the year. Money, credit, and financial markets developments. Broad money supply M2 grew by 0.01% in April 2012 when compared to the level at end of December. Relative to the level at end of December, aggregate domestic credit net declined by 2.04% in April, translating to a decline of 6.12% on an annualized basis. The decline in aggregate credit during the period was mainly due to the decline in credit to the core private sector. Credit to the core private sector declined by 0.22% or 0.66% on an annualized basis, while credit to government net declined by 58% in Q1 of 2012. Despite the decline in credit to the core private sector, overall credit to the private sector rose marginally by 0.06% or 0.18% on an annualized basis. This is indicative of a disturbing trend of growth in lending to state and local governments at the expense of lending to the core private sector. Following these developments, the committee reiterated its earlier advice that the bank should put in place appropriate measures that would enhance the flow of credit to the private sector, in particular to those activities that have the potential of inducing growth in a relatively short period of time. The committee noted that since its meeting in March 2012, money market interest rates have remained anchored around the upper band of the interest rate corridor. The interbank core and OBB rates, which opened on March 19th at 15.42% and 14% respectively, closed at 14.66 and 14.34% respectively on May 17th. The medium to long-term yields have also eased during the period. The committee further noted a slight reduction in the spread between deposit and lending rates. The average maximum lending rate rose to 23.31% in April 2012 from 23.21% in March, while the consolidated deposit rate rose to 3.93% from 3.79% during the same period. Thus, the spread between the average maximum lending rate and the consolidated deposit rate narrowed further to 19.38% in April from 19.42% in March. The external sector. Foreign exchange reserves as at end of April 2012 stood at $36.66 billion, representing an increase of $4.02 billion or 12.32% above the level of $32.64 billion as at end of December. Reserves increased to $38.72 billion as at 17th May, representing an 18.63% increase over the level in December 2011. The increase reflected generally favorable commodity prices and inflows of capital in response to the removal of restrictions on repatriation and high domestic interest rates, as well as stable exchange rates. The committee noted the assurances of the bank that total hot money in the system is under strict surveillance and that the bank is satisfied that the figure of $5 billion does not pose a significant threat to the financial stability of the country in view of the current level of reserves. The exchange rate at WDAS spot opened at 157.62 naira to the dollar on March 20, 2012 and closed at 157.26 to the dollar on May 17th, indicating an appreciation of 0.36 kobo or 36 kobo or 0.23%. At the interbank segment, the selling rate opened at 157.7 and closed at 158.8 to the dollar, representing a depreciation of 1.1 naira or 0.7%. At the BDC segment of the foreign exchange market, the selling rate opened at 160 naira to the dollar and closed at 159 naira to the dollar, representing an appreciation of 1 naira or 0.06% during the same period. The committee noted the decline in the premium between the rates at WDAS and Interbank and between the WDAS and BDC towards the end of the review period, while noting the need to put in place policies that would attract capital inflows necessary to build up adequate external reserves. The committee urged the bank to sustain and complement existing measures to discourage speculative demand for foreign exchange. The committee commended the bank for taking proactive steps to intervene in the interbank market to maintain the exchange rate within the target band. The committee also commended the efforts of the bank in monitoring the foreign exchange demand and capital inflows into the economy with a view to ring-fencing the economy from external shocks and other vulnerabilities, and in building the stock of reserves to meet genuine demand for foreign exchange. The committee expressed satisfaction with the orderliness of the foreign exchange market and the stability of the exchange rate. It also encouraged the bank to continue its close surveillance of activities in the foreign exchange market, given the current developments in the international currency and financial markets. The committee's considerations. The key concerns noted by the committee were: 1. A slowdown in global economic activity, particularly in the US, Eurozone, and China. 2. A slowdown in domestic output, especially the sharp decline in agricultural output and oil and gas sector. 3. Possible softening of crude oil prices in international markets with potential fiscal revenue losses and the likely pressure on the foreign exchange market and exchange rate. 4. The inflationary threat that has resurfaced in the first quarter of 2012 after having moderated in the fourth quarter of 2011. 5. Imminent increase in electricity tariff, which may lead to further inflationary pressures. 6. High interest rates in the face of declining GDP growth. 7. Security concerns in different parts of the country. And 8. The very slow pace in structural reforms, evidenced by failure to improve on power supply, establish and implement reliable PPP frameworks that can attract funding for infrastructure, and delays in passing the petroleum industry bill. The committee noted that since its meeting in March 2012, the uncertainty surrounding the global economy remained elevated owing to continued economic slowdown in advanced and major emerging economies, as well as the financial stress in key advanced economies. These developments will have an impact on the domestic economy through the trade and financial flow channels, weakening the external and fiscal positions. Monetary policy on its own has limitations with respect to inducing growth without fiscal and structural measures relating to the petroleum, power, and infrastructure sectors. The committee reiterated the need to recognize the short-term nature and limits of monetary policy. The growth and development of the Nigerian economy will continue to be at risk so long as progress is not made in structural reforms. Furthermore, the committee reassessed the recently released provisional output data, which indicated a slowdown in agricultural GDP growth. It noted the huge drop in agricultural output that was traced to the following factors: displacement of farmers in the northern part of the country owing to security situation, inadequate rainfall, and increased production cost due to the partial removal of fuel subsidy in January. It also noted the decline in oil and gas production and the recent revelation by the oil minister of the loss of over $7 billion of revenues due to oil theft. It concluded that interest rate movements would not be effective in stimulating growth under such circumstances and urged government to fast-track the ongoing agricultural transformation initiative and to strengthen fiscal controls over the oil industry. The committee also noted that while the lingering impact of aggressive monetary tightening measures undertaken since 2012 served to moderate pressure on domestic prices in the near term, the effect of global economic and financial developments on exchange rates and domestic prices could be significant in the coming months. The international oil price output and the lag in oil supplies in relation to demand seemed to indicate the onset of additional pressures on foreign exchange reserves, exchange rates, and prices. These developments require that the power and petroleum sector reforms, as well as infrastructure investments, need to be scaled up as quickly as possible. These should complement measures to enhance credit flows to the private sector, in particular to growth-inducing activities, so that the likely pressures on the market are addressed. The committee welcomed the efforts being made to improve fiscal consolidation. Government revenues have improved in Q1 in relation to government expenditures, resulting in a notional fiscal surplus. The committee encourages that these efforts are furthered, especially in view of the growing domestic public debt stock. The committee also noted the very healthy collaboration that has been established between fiscal and monetary authorities and urged the bank to continue supporting fiscal authorities in their pursuit of very difficult reforms. The committee evaluated the policy options available to it and the analysis of alternative scenarios and agreed that monetary policy should contribute to the consolidation of a positive and stable longer-term macroeconomic environment conducive for growth and development. It was the committee's view that at this point in time, the trajectory of prices and output is more dependent on fiscal and structural policy than on monetary policy. The sluggish growth in credit, the stable exchange rate, the healthy reserve position, and the benign month-on-month inflation do not suggest a need for further tightening at this point. Also, the steady growth, the reasons given for the slowdown in agricultural growth and the oil sector will not be addressed by monetary easing. Decision. The committee therefore decided by a unanimous vote to maintain the current stance of monetary policy without discounting the possibility of changing it should economic and financial conditions warrant such in the near term. As such, the monetary policy rate is retained at 12%, with the symmetric band at plus or minus 200 basis points, while the CRR and the liquidity ratio remain unchanged. Thank you.
I'd like you to quickly ask your questions, introduce yourself and the organization, and please keep it